Hello everybody, my name is Elisha Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This video is about one of the most basic strategies for investing, which everyone defaults to out of necessity. I want to talk to you about dollar cost averaging, from here on out called DCA, and rebalancing your portfolio, and then do a quick comparison to lump sum investing. Dollar cost averaging is buying the same asset monthly, quarterly, etc. for the same amount of money each time, thus buying more if the asset has gone down in value from the previous time. This protects you against bear, that is, downtrending markets. For example, as shown here, if I am buying the same asset with the same $500 every month, as the price goes down, I am buying more. And then when the price recovers somewhat, but not all the way to where it was before, only going to $8 per share while it started at 10, I am still higher than the $6,000 I put in, worth $6,463.49, because I was buying shares at $6 for the lowest point. I also bought over 807 shares rather than the 600 that I would have gotten if the share price stayed at $10. I would get only 600 shares in the year in that case. Dollar cost averaging is typically done using a pre-authorized payment, a PAP, so the money is withdrawn automatically from your checking account and the investor doesn't miss it coming out of their account. This also addresses the problem that some people have when they spend all the money in their checking account, so there is nothing left to invest. By using the pre-authorized payment, the money is taken out before it is spent. A necessary second step of the DCA strategy is rebalancing. I have to say that I have had many financial advisors over the years, but I can't recall even one doing rebalancing for me. My personal theory is that there's little commission in it for them and just extra work, so they never do it. But I could be wrong. Rebalancing your portfolio is performed every 6 to 12 months, or when the portfolio mix of assets has moved significantly away from the investor's risk profile by having the percentages be off more than 5%, for example. It is the assets being out of proportion that triggers the rebalancing. They could have both gone up, but at different rates. Both could have gone down, but at different rates. Or one could have gone up and the other one down. It's the proportion that matters, and that's what triggers the rebalancing. Rebalancing returns the portfolio back to the appropriate proportions. By selling the assets that have a larger proportion of the portfolio than originally intended, and buying those assets that have a smaller proportion of the portfolio than originally intended. This sells high, buys low for the portfolio, and reestablishes the desired risk profile. And it does make a significant difference in performance, up to 3% annually, depending on the research study that you're looking at. To continue with my example, if you choose 2 ETFs to put money into, A and B, and choose to put 500 into each one, I would expect each A and B to be 50% of my portfolio if they stayed in balance, which they never do. They are different investments after all. This is why you bought them. At the end of the year, A is worth $6,463.49, and B did quite well and is worth an even $7,500, which is over a 25% return. But this means we are now more exposed to B than we want to be at 54% of our portfolio and need to rebalance the portfolio. So doing the math, our target is the average value of A and B, which is $6,981.75. So we need to sell $518.25 of B and buy the same amount of A. This will get both assets back to balance at $6,981.75 each. Depending on the account type, RRSP versus TFSA versus non-registered, you may consider rebalancing by buying more of the lower asset to avoid selling the higher asset. This may save you fees in all accounts and capital gains taxes in a non-registered account. So let's look at lump sum, which is putting in a one-time large amount of money rather than putting it in 1 month at a time. So if you have the full amount of money available, most of the time you will come out ahead if you put the whole amount in, since we are assuming an uptrending market. DCA will win if there's an extended downturn. As you can see from the picture, lump sum lets you get all of the profit in one big shot, and in the uptrending market, that wins compared to DCA's smaller and smaller profits as the market goes up. However, since you are putting in your money as you are earning it at work, DCA is your only option. Unless you have $1 million available now to invest, you can't use lump sum because you don't have the money yet. So that was dollar cost averaging and its close friend, rebalancing. So if you have any questions or if you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.